Welcome to the CFA Level I presentation on the basics of portfolio planning and construction. The most important concept in the process of creating a portfolio is to create the investment portfolio statement, or the IPS. So let's see what this IPS is all about. First of all, the IPS defines the investor's risk and return goals given the investor's profile and market expectations. So in simple terms, if we have a market that is expected to do very well and the investor is such who can take a lot of risk, then we define return objectives, which we will talk about on the next few slides. But very roughly speaking, we might say that the return objective is to generate a return of 15% and a risk profile of risk is above average risk. How we come up with these terms we will talk about shortly, but this is perhaps one of the most important parts of the investment policy statement, where we are defining the investor's risk and return objectives. So once we create the investment policy statement, which by the way will have a lot more detail, which we will cover in the next few slides, but nevertheless this IPS helps ensure that the investor has realistic expectations about the market. So clearly the risk return objectives need to be set in the context of the market. And while every investor would expect returns to be very high at a very low level of risk, but that might not be possible. So it is the job of the investment advisor to help the investor understand what is reasonable given the level of risk that the investor can take, and then essentially document this information in the IPS. So by documenting the discussion or the understanding between the investment advisor and the client, the IPS helps put the investment advisor and the investor on the same page. So let's say an IPS is created, risk return objectives are talked about, discussed, and then documented. Then the actions that will take place after that will be in the context of the IPS. The measurement of whether the investment advisor has been able to meet expectations or not will again be in the context of the IPS. Let's now talk about the major components of the IPS. First, it should have an introduction which basically describes the client. So in this segment, for example, if we have a client who is 65 years old and is about to retire soon, has moderate savings, so this information about the client will be documented, and it will serve as a context under which we create the actual return objectives, risk objectives, and so on. The next is the statement of purpose. This basically defines the purpose of the IPS. Then duties and responsibilities. So this details the duties and responsibilities of the client, the custodian of the client's assets, and the investment manager. So everybody then clearly understands what their responsibilities are in the context of the investment process. Next, we document the procedures. This section explains the steps to keep the IPS current and the procedures to follow to respond to various contingencies. Next, we document the investment objectives. So this explains the client's objectives, and on the next few slides we'll specifically talk about the most important objectives, which are the return objectives and the risk objectives. We then talk about investment constraints. There are 5 constraints which we will talk about soon. Investment guidelines. This section provides information about how policy should be executed and on specific types of assets excluded from the investments, if any. And then we have evaluation and review. So this provides an explanation or guidance on how we obtain feedback on investment results. And finally, We have appendices which will talk about strategic asset allocation, rebalancing policy, and so on, which we will again discuss later in this presentation. Now, as I mentioned earlier, the most important part of the IPS is the risk and return objectives of the investor. Let's first talk about the risk objectives, because the return will then need to be defined in the context of the risk. So a risk objective specifies the client's risk tolerance. Risk objectives can be expressed either as absolute risk objectives or relative risk objectives. Let's take an example first of absolute risk objectives. Here the client, so for example, if we determine, when I'm saying we are doing this from the context of an investment advisor. So we determine that the client does not want to suffer more than 5% capital loss. Okay, so if the investor has invested $100,000, he doesn't want to lose more than $5,000 in any 12-month period. So practically this might be stated as follows, that with 95% probability the portfolio should not lose more than 5% value in 12 months. Later on you will discover that this sounds a lot like value at risk, but essentially this is all you need to know right now in terms of how to express a risk objective in absolute terms. Risk objectives can also be stated in relative terms. So if we say that the return must be within 4% of the S&P 500, this means, so this sounds like return, but essentially there is an element of risk involved here. So essentially we are saying that the return of the portfolio has a certain variation measured by the standard deviation of the portfolio. And essentially what we are saying here is that the standard deviation of the portfolio should roughly track the standard deviation of an index. Let's say that the index we are concerned about is the S&P 500. Now this might be a little detailed for level 1, but just in case, there is an important concept of tracing error. Actually this is called the tracking error. So with the tracking error, essentially we are saying that the standard deviation of our portfolio should track the S&P 500, and more specifically if we say that the tracking error is 2%, what we are saying is that the standard deviation or the riskiness of the portfolio minus the riskiness of the S&P 500 should be less than 2%. And those of you who are strong on your statistics will realize that if we can keep this tracking error under control, then we can say with 95% probability that the return will be approximately within 4% of the S&P 500. And what I mean by return is the return of the portfolio. So as long as you just remember this, that's good enough. But the key idea is to understand the high-level distinction between stating risk objectives in absolute terms and relative terms. This material is explained in the curriculum. It's not really explained in Schwezer notes. But as long as you followed roughly what I said, you should be in good shape for the exam. Let's talk a little more about risk objectives. When we talk about the riskiness that a client is willing to take, we need to distinguish between the willingness to take risk and the ability to take risk. The willingness to take risk is a psychological factor. So this depends on the risk profile of an individual. Willingness means that somebody by nature is more willing or can take risk more easily. So when you are evaluating a client, somebody who likes to go hang gliding and parachuting and so on, and likes to drive fast cars, that person inherently is more willing to take risk. Ability to take risk refers to the specific situation of a client, and the example that I frequently give, somebody who is 65 years old, retiring in a few years, has moderate savings, his ability to take risk is clearly low, because he needs to put his money in a relatively safe investment. The last thing he can afford to do is invest in high risk securities and then find out that by the time he retires he has nothing. So his ability to take risk is low. His willingness might be high. So for example, if he's the sort of guy that I just talked about who likes to jump off planes and parachute and so on, so his willingness might be high. So we need to consider both the willingness and the ability to come up with the risk profile of an individual. The risk profile will typically be expressed as high, medium or low. So here we don't talk about standard deviations. We simply say that in this particular case, the example that I just gave, we would say that the risk profile of the investor is low. Notice that the ability to take risk generally will trump the willingness. And what you need to be ready for is scenario-based questions here, where in the exam you might be given the profile of an investor and you will have to say that his risk profile is either high, medium or low. A few good examples in the curriculum on this which you should look at. Next, let's talk about return objectives. Return objectives can also be stated in absolute terms or on a relative basis. Here is an example of absolute. So absolute return objectives. If a client wants to achieve a particular return, for example, a return of 15% on a inflation adjusted level, then we say that this is a absolute return. Absolute returns can also be stated on on an inflation adjusted or a real basis. So if the inflation in our country is 13%, then stating that our inflation adjusted return or real return should be 2% is also an example of a absolute return objective. Key point being that on the exam you might see something stated in nominal terms, so the default is nominal, but it's okay to also state return objectives in real terms. Real terms is sometimes referred to as inflation adjusted. Return can also be stated in relative terms. So if we say that our return should be greater than 12-month CIBOR or 2% greater than 12-month LIBOR, then this is a relative return. Or we might say that our return should exceed the S&P 500. So anytime we are comparing with some sort of a benchmark, that would be an example of a relative return. Fundamental point is that the stated risk and return must be compatible. So we cannot have low risk and high return. So this is not possible. Whatever return we are documenting for our client or we are stating in our objectives should be in line and acceptable given the level of risk that the client is taking. And from an investment advisor perspective, this is a critical element where many clients might not be familiar with this trade-off between risk and return, and hence it's the job of the investment advisor to make sure that clients understand this trade-off and objectives of risk and return are balanced and compatible. I would strongly advise you to do example 4 from the curriculum, which combines concepts of portfolio management and quantitative methods. This material is new in the level 1 curriculum and hence probably will be tested. So when you look at that example, it's pretty straightforward. There is a client who will retire in 20 years. He will need 2 million in today's money. What this means is that his amount that he needs to retire is 2 million given today's cost of living. The problem then goes on to state that inflation is 2% and the amount he can invest today is 900,000 and that he will not be able to invest any more money. So how much will he need in 20 years given the value of money in 20 years? All we do there is use the 2% inflation. So 2 million in today's terms will be what in 20 years. So given a 2% inflation, we simply do 2 million into 1.02 to the power of 20, or using the calculator, you can plug in PV is equal to 2 million and N is equal to 20 years, and you can put in interest rate is equal to 2 and compute the FV. Payments, by the way, are 0. What about the second part? What is the return objective? Now, this again is straightforward. We are investing 900,000. So this is your PV. The 900,000, this needs to become roughly 3 million in 20 years. So again, on the calculator, this becomes your PV, this becomes your FV, this is your N, and then you need to compute the interest rate or the return. Payments again will be 0. So you do this calculation and you should get approximately 6.2%. So in this case, we are setting an absolute return objective of 6%. Again, go through this example on the curriculum. I think there is a high probability that you will see something like this on the exam. Schwezer notes, by the way, in their reading do not have an example on this. Investment constraints. Now, you need to memorize these 5 constraints and you need to understand briefly what they mean. Time horizon refers to the time horizon that our investor has. So in the example that we just saw, the time horizon is relatively long. It is 20 years. In an earlier example, I talked about an investor who is 65, retiring in 5 years. So this investor only has a time horizon of 5 years, which is shorter. Why is it so important to understand the time horizon? Because this is a critical, this helps us determine, among other things, the risk objective. Clearly, a client who has a longer time horizon can take a little more risk because he will not be as concerned about the short-term fluctuations in the capital markets. So time horizon refers to after how long the money is or the investment needs to be taken out, and that determines our, among other things, that determines our riskiness. Next is tax situation. So this is the tax situation of your client. Some clients might be in a high tax bracket, others might be in a low tax bracket. So by understanding your client's tax situation, you can help him or her determine what investments to make. Someone who is in the high tax bracket, for example, might be well served investing in municipal bonds, which are tax exempt. Liquidity refers to how quickly your client might need cash. So a client who on an unexpected basis might easily need a certain sum of money has a high liquidity requirement. So we talked earlier, a few lectures ago, about the insurance business, and within insurance, let's say that there is the property and casualty business. So if your client is an insurance fund in this line of work, their liquidity requirement will be high, because anytime there is a valid insurance claim, they have to liquidate some of the investment, and clearly they would not want to have their investments in illiquid areas such as VCs or say hedge funds. So understanding the liquidity needs of your client is extremely important, as that helps determine what sort of investments to make. Legal and regulatory refers to any laws that your client must follow. As an example, there might be certain laws that banks are not allowed to invest in certain kinds of investments or instruments, and as an investment advisor, you need to understand what legal framework your client is operating in. And finally, unique circumstances refers to the specific unique circumstances of your client. So for example, you might have a client who does not want to invest in alcohol, tobacco and firearms related companies. So that is a specific constraint of your client, where investing in, say, tobacco based companies is legal, but that particular investor does not want to invest in tobacco companies for moral reasons or ethical reasons, and that then needs to be documented under the unique circumstances segment of the investment constraints. Now, a quick way to memorize the most important components of the IPS is as follows. Just remember this RRTTLU. R and R stands for risk and return, which we've talked about before, and then TTLLU is simply what you see here: the time horizon, tax situation, liquidity, legal and unique constraints. So this is actually a nice tip in Shweta. So I would encourage you to memorize this little phrase RRTTLLU. That way you remember the most important parts of the IPS. So now let's talk about the portfolio construction process. To do so, first let's understand the basics. So what are asset classes and what does strategic asset allocation mean? We've talked about this briefly earlier. Asset classes are basically different classes of assets such as stocks, bonds, and more recently this class of assets called alternative investments has become more popular, and within alternative investments you can have commodities, you can have real estate, hedge funds, etc. Within stocks you can then have different categories of stocks such as small cap, mid cap, large cap. You can also have categories that are defined as US stocks, European stocks, emerging market stocks, and so on. Bonds can be subcategorized based on government versus corporate, or you can also subcategorize based on maturity. So asset classes can be defined in many different ways, but if we want to keep it simple, the most basic kinds of asset classes would be stocks, bonds, and alternative investments. Strategic asset allocation refers to how we allocate our clients' money across different asset classes. And to get a nice picture of this, I'd suggest you look at example 10 in the curriculum, which is on page 471 of the 2011 Level 1 curriculum. So there you will see overall mix of 60% invested in equities, convertible bonds, private equity, etc., and then another 40% invested in fixed income securities. So when you look at that exhibit, essentially you will see a percent allocation against different asset classes. So that shows us, that will help you understand the meaning of asset classes and strategic asset allocation. Next, let's talk about how we actually construct the portfolio, or how we come up with a strategic asset allocation. There are two key elements, and those two key elements are the capital market expectations and the IPS. So the capital market expectation refers to our expectation about how the stock markets will do and the riskiness, how the bond markets will do. So essentially our expectations about the risk and return of different asset classes. IPS tells us about the profile of the investor, what level of risk he can take and what are his return objectives and so on. So based on a combination of our capital market expectations and the IPS, we come up with we run an optimization program, or so we feed all this information essentially into a computer program that basically runs optimization or runs a simulation, and based on that simulation we will come up with a strategic asset allocation for our client. So that strategic asset allocation might be something like 60% in equities and 40% in bonds or fixed income securities, and then there might be a further subdivision in terms of sub-asset classes. So this is essentially at a high level how a portfolio is constructed. Now a few other points. Remember on an earlier lecture I talked about combining details of the market with details of the investor. In terms of the capital market expectation, if we look at risk versus return, the capital market expectation allowed us to create an efficient frontier, and then based on the risk-free rate and the efficient frontier, we created this capital allocation line. So essentially the capital allocation line is coming based on capital market expectations. And then the IPS helps define the utility curves of our client. So these then are the utility curves of our client, and we want to create a portfolio that maximizes the utility of our client. So if this is utility curve 1, this is utility curve 2, these are also called indifference curves, by the way. We want to be on the utility curve that gives our client the highest level of utility or happiness. So essentially we will go with this portfolio here, which is where the highest utility curve is tangential to the capital allocation line. And again, the equation for these utility curves is given by U is equal to expected return of portfolio minus lambda sigma p squared. In an earlier reading, instead of lambda, we had used A. So this essentially is the level of risk averseness. So the more risk averse an investor is, the higher the lambda or the A. And U is fixed for a given utility curve. The higher the U, the higher the utility, and we are then on a higher utility curve. So if you are slightly confused about this, you can go back a few lectures on the efficient frontier, the cal, and the utility curves. But hopefully this is not too difficult. Let's continue with portfolio construction and a few more terms that you might see on the exam. One important term is risk budgeting, and we just need to know this at a high level, don't need to get into details. So under risk budgeting, we need to do two things. First, decide on the total risk in the portfolio. So this is called our overall risk budget. So this is the amount of risk that our investor can take. And then we subdivide this risk. So this is now the budgeting exercise. So we subdivide our risk over the sources of investment return. And the sources of investment return are the strategic asset allocation, the tactical asset allocation, and security selection. We've already talked about strategic asset allocation. What we mean by tactical asset allocation is as follows. Let's say we've made a strategic allocation of 60% in equity and 40% in fixed income securities. And let's say that we are expecting interest rates to fall substantially in the near future, and hence we expect fixed income securities to do very well. So on a tactical basis, which means let's say for the relative short term, we might reduce our weightage of equity to 55% and increase our weightage of fixed income securities to 45%. So this would correspond to our strategic asset allocation, and this tactical adjustment that we have made, this corresponds to our tactical asset allocation. Security selection then refers to what particular securities that we are choosing, and the default would be, let's say if we are in Pakistan, then to simply match the KSE 100. So we would buy the various shares in the KSE 100. Now security selection means that if within the KSE 100 we are, let's say, bullish on the fertilizer sector, then we might overweight the fertilizer sector, and by overweight I mean overweight relative to the weightage of the fertilizer sector in the KSE 100. And then within the fertilizer sector we might be bullish on FFC. So if we overweight FFC in our investors portfolio, then essentially what we are doing is security selection. So we are hoping that with our tactical allocation as well as with our security selection, we are going to beat the market, or we are going to help generate higher returns for our client. So that essentially is it. We've covered this at a high level, and I feel that's good enough for level 1. this material will be covered in a tremendous amount of detail in level 3. So that's it. As always, practice. If you have any comments, please post them on YouTube. If you liked this video, then please click on the like button. That is it. Thank you very much.